Thank you all for joining us, everyone. I'll just give everybody a second to get logged in this morning. We do have a notice showing for you. As of late last night, the SBA released version 8 of the FAQs on shuttered venue operators grants. This application portal opens tomorrow. So please make sure that you note this website address that's being displayed. And you can certainly email us after this presentation and we can send you a copy of this link. So good morning, everyone. Thank you so much for joining us today. For this session, Summit is proud to partner with BKD. Today, we'll be taking a deep dive into the American Rescue Plan Act. President Biden recently signed the ARPA into law, and today we will cover the key features of this new legislation and how it will impact ERC and PPP. We do have the Q&A feature available, so please submit any questions through that option. If there's time at the end of today's session, those questions will get addressed. You can also submit any questions to us via email at marketing@yoursummit.com, and I will be sure to display that email address again near the end of the session. So let's get started. We have 4 guests joining us today. Our first guest is Tad Goodenbour. Tad is one of BKD's technical area specialists in partnership taxation and has 4 decades of experience in public accounting. He also has been a subject matter expert in the PPP and employee retention credits. Tad currently serves as a trustee of the Kane Family Foundation, and he is a member of the American Institute of CPAs and Colorado Society of CPAs. Our next guest is Jesse Palmer. Jesse is a partner in BKD's National Office Tax Department and serves as the firm's Director of Tax Quality Control. Jesse serves as the co-chair of the firm's tax committee and works closely with the National Tax Director on firm-wide tax-related growth initiatives. Jesse is a member of the American Institute of CPAs and Missouri Society of CPAs. Our next guest is Angie Tai. Angie is a CPA and has more than 23 years of public accounting experience. Angie is a member of the American Institute of CPAs and Oklahoma Society of CPAs. Angie was honored as one of the 50 Making a Difference as part of the Journal Records Women of the Year Awards programs, and as a 2015 Woman of Distinction by Tulsa Business and Legal News. And our last guest is Jill Young. With more than 2 decades on the Summit leadership team, Jill began as the Chief Business Development Officer, serving for 8 years while also supervising numerous registered representatives throughout the US. As Summit's compliance officer, Jill currently serves as general counsel, and she's building and developing relationships with our community and our clients. So now I will pass the session off to Jill to get started.
Good morning, everyone, and welcome to our first webinar of 2021. It's great to be on this call with all of you all today. At Summit, we recognize these are hot topics, and we've received a lot of calls and emails from our large corporate clients, nonprofits, small businesses, and business owners, and also individuals who are asking us questions about tax law changes, the deadlines, PPP, ERC, and so much more. So we know this is time-sensitive information, as these changes could impact your business or you personally. So we reached out to our partners at BKD and we asked them to educate you, our valued clients and friends. And so they're a great resource for us and for you, and their team is here to help keep us all informed. So we have a lot to unpack here today, and let's get started with the BKD team. Without further ado, I'm going to turn it over to Jesse Palmer. Feel free to ask questions during the presentation in the chat box.
Right. Well, thank you, Jill, for the introduction, and Megan as well. Glad to be here. Good morning. I guess it is still morning, everybody. Happy April. We're about a little over a year now into obviously all the changes that have come down the road with the CARES Act and the Consolidated Appropriations Act, and most recently the American Rescue Plan Act, which is really what we're going to be focusing on today. And I think, Megan, you're sharing, or will be sharing the presentation here shortly. Yeah. So basically what we'd like to cover today if you can go on the next slide for me. Um, we are going to be covering the American Rescue Plan Act of 2021, which was signed into law back in March 11th. Again, another stimulus bill that was passed. This one was about 1.9 trillion total cost of the bill, and included various aid for vaccinations, testing, aid for state and local governments, schools, as well as certain industries such as agriculture and airline. But it also contained several tax-related provisions as well as some additional business relief. So what we're really going to be focusing on today is probably that last bullet, more so the tax-related provisions and some of the business relief provisions that Angie and Ted and I will be covering here over the next hour. So with that, we'll just get right into it with the first section, which is going to be some of the various provisions that was in the RPA as it relates to individuals. So the first one I want to hit on is the recovery rebate checks, or this has been called various things: economic income payments, or stimulus payments, stimulus checks. This is essentially the third round of the stimulus checks. So there were two rounds related to 2020. This is another round, and this one is $1,400 per individual for joint filers to be $2,800, as well as each qualifying dependent is also an additional $1,400. And this includes also full-time students that are younger than the age of 24, as well as adult dependents. Much like the first two rounds of checks, there are phase outs. So if you're a high income earner, it can be phased out where you would not receive a stimulus check. The one thing with this one is it's a much more narrow window in terms of when the phase out ends. So as you can see here in the bullet, between 75,000 and 80,000 for an individual, once your AGI, adjusted gross income, exceeds 75,000, your check starts to the phase out starts to apply, and it phases out completely at 80,000 of adjusted gross income. And then for married, finally joint couples, it's 150,000 and 160,000. And it's based on either your 2019 or 2020 tax return, depending on when you have filed, or if you have filed your 2020 return yet. So if you have not filed your 2020 return, the IRS will base the check on your 2019 data. So given the phase out of this, it's important to be thinking about this, particularly with your 2020 filings. If your AGI on your new 2019 return is below these thresholds, but your 2020 is going to be over, it may be a good planning strategy to hold off filing your 2020 return until you receive the check. And the IRS has issued quite a bit of the stimulus payments already. So for those who qualify based on 2019, they may have already received their check. However, if your 2019 was over, but your 2020 is under, then it might make sense to file your 2020 as soon as you can to at least get the advance check. Now, much like the last two stimulus payments, didn't receive a check but were eligible, you are able to still receive the credit for it, or the benefit for it. But for this one, if you don't get the check, you would claim it essentially as a credit on your 2021 tax return. Okay, so next slide, Megan. Another provision in the RPA was related to unemployment benefits. And this was an extension of unemployment, federal unemployment supplement that was in previous stimulus bills. This one extended that supplement, federal unemployment, for $300 weekly. That's been now extended through September 6th of this year. And then also a big one that's received a lot of news is they also provided an exclusion for unemployment benefits that an individual received in 2020, up to $10,200 per individual. Now this exclusion benefit phases out if your adjusted gross income is 150,000 or more, and it's the cliff. So once you hit 150,000, you don't get any exclusion. So again, that's where some planning might come into play in terms of trying to make sure if you're near that AGI threshold, to try to stay under the 150 if you have unemployment benefits because of that 10,200 exclusion. Now, with the passage of this bill and right in the middle of tax season, Certainly there are several individuals that are probably already filed a 2020 return reporting that as income. And so the question is, do I need to file an amended return to take advantage of that exclusion? Well, the IRS recently came out with guidance to say, we will basically do the calculations for you and issue a refund if you had unemployment benefits but could exclude them. And based on their announcement, they're going to be doing this over the summer, starting as early as in May, to start issuing refunds for those taxpayers that might benefit from the exclusion. Now, the one caveat is if doing the exclusion would make you eligible for other types of credits, such as like the savers credit or earned income tax credit or other things, then the IRS does advise taxpayers to go ahead and file an amended return to claim that exclusion, as well as any new credits they might be able to take advantage of. Okay, the next provision we're going to talk about is the child tax credit. For 2021, this bill made that child tax credit fully refundable. So even if you have no tax liability, you can get a full refund of the credit amount. It also makes up to 17-year-old dependents eligible as qualifying children for the credit. And they increase the credit from the current $2,000 to $3,000 per child. But for those children that are younger than 6 years old, the credit is increased to $3,600. And they also increase the phase out amounts that you lose the benefit of this credit to $150,000 for married couples and $75,000 for single. Also for 2021, the bill also provided a provision that directs the IRS to provide monthly advance payments of a portion of this credit from July through December. So instead of waiting until you file your 2021 return, the IRS has been directed to provide essentially an advance of that credit throughout the years, again, starting in July through December. Now the IRS is been directed to create a portal to manage all this. So whether or not they'll get this up and running here by the July date remains to be seen, but that is what's in the law for them to do. Now they do provide an option that taxpayers can opt out of this advance payment if they choose to do so by going to this portal that's going to be established by the IRS. Okay, the next provision is the earned income tax credit. There were several changes here to that credit, the EITC as it's commonly referred to as. It did change the rules for individuals with no children for 2021. It decreased the minimum age to 19, except for students, the minimum age is 24. The maximum age has also been eliminated. They've also increased the phase out percentage to 15.3%. And then also if you have investment income that could potentially disqualify you from being eligible for the EITC, they've upped that threshold from $2,200 to $10,000 of investment income that you can earn and still not be disqualified from the EITC. And then also they allow taxpayers to essentially use their 2019 income instead of 2021 if that results in a better earned income tax credit benefit. Okay, the next slide is on the child and dependent care credit. Some changes here. They did make the credit fully refundable for 2021. The credit is now equal to 50% of eligible expenses up to a limit that's based on the taxpayer's income. And it's up to $4,000 for one individual or $8,000 for two or more. So 50% of those amounts. Now the phase out of that credit begins at income levels of more than $125,000, but also for those high earner households with income over $400,000, their credit now can be reduced below 20%, which is a change. In the past. Regardless of how much money you earn, you can still get at least a 20% credit based on the eligible expenses, but there is now a phase out put in place for that. And then from an employer perspective, that provide employer provided dependent care assistance to their employees, that exclusion has been increased to $10,000 to $10,500. Okay, and then the next provision, this was actually one of the only revenue raisers really in the bill, but this is actually unfavorable for taxpayers. But this relates to the excess business loss limitation, which was originally enacted as part of tax reform back in 2017, but essentially for those individuals that have income from a pass-through entity, so an S corporation or partnership that's generating losses. And they're active in that business, where normally you wouldn't have a limitation, at least under the passive loss rules, to deduct your losses. They did enact a limitation of only being able to deduct up to $250,000 for individual, or $500,000 for joint filers, that you could deduct in 1 year, and any excess would be carried forward as a net operating loss. The limit was originally supposed to apply for tax years 18 through 25. Under the CARES Act last year, they suspended that limitation for 2018 through 2020, which is still in effect. However, under the ARPA, they did extend this limitation 1 more year, so to 2026. So essentially, the limitation will apply again for tax years 2021 now through 2026. And then finally, on the individual side, there was a provision added to essentially exclude from taxable income if you're an individual had a student loan that was discharged in 2021 through 2025. This act allowed those that forgiven debt essentially to be excluded from taxable income. Now, it didn't actually include any direct forgiveness of any student loans within the act, but it just set it up to say if for some reason a student loan debt is discharged during the next 4 years, then it will not be taxable income. Okay, so that was pretty much the main individual related provisions, but obviously we want to focus most of our time on what's going to be impacting businesses. So both for-profit and not-for-profit businesses, a lot of very favorable relief provisions available. So I'm going to turn it over to Tad, and he's going to talk through some of those ARPA related provisions for organizations. So Tad, I'll turn it to you.
Thank you very much, Jesse. Appreciate that. Before we go to the next slide, I want to kind of go back to the notice or the reference we had posted at the beginning of the program for the shuttered venue operators grants. I know a number of people out there, are gearing up to apply for that tomorrow, which is going to be it's going to be interesting to see what happens when it's, been billed as a first come, first serve and the portal's open, tomorrow. They don't tell you what time, but anybody that's been kind of looking at that, gathering their information, going through the checklist and everything, I really, really strongly encourage you to take a look at that new FAQ out there. Jesse, I think, what do you count, 73? Either new or newly changed provisions out there, and some of them, I think, Jesse, are pretty relevant. So I just would caution you to take a look at that and make sure that all your documents are in order and ready to go. And Godspeed and good luck to you if you're gonna throw into that fray tomorrow. So be interesting to see what happens, as to what the results are. But just again, take a look at that thing to get the newer one and see what provisions that may apply to you. So okay, enough of that one. Although we will talk about it a little bit later. Can we go to the next slide, please? Okay. One, and I'm just going to touch on this really quickly. It's a provision that I think started out, people were pretty excited about it, only because it was mandated for certain employers to provide the paid sick and family leave to their employers. The mandate to provide that expired on December 31st, but with the new act here, it actually was extended the credit, because remember, they forced you to pay people for certain time off and for leave. They force you to pay those people, but you got 100% credit for it back against your payroll taxes, and it was refundable credit. So kind of was a net not out of pocket. Well, the mandate ended on December 31st to provide that benefit, but if you still choose to provide that benefit, the credit is still available to you. They increased the limit to $12,000 per employee. The credit actually now is going out to, I believe, September 30th is where it's gonna go out to. It initially expired about a week ago on March 31st, but the new bill actually extended that out. They extended out the reasons for the credit. You can actually give them, paid time off and get the credit for vaccinations, which might be a bit of an administrative, hassle from your perspective. But if you have a large number of employees that you are given the time off for, it could be a pretty big number. So anyway, just one more thing to think about as you kind of go through the mass of credits that are available to you. And remember that you can never double dip. So you've got to take that into account when you're looking at your retention credits, you're looking at your PPP loan. Any people out there that are hospitals that got, recovery or recovery relief funds, any number of different, CARES Act funding that have prohibitions against double dipping. You just gotta make sure that you track what you're using the actual payroll for. Okay, next slide, please. Okay, a couple of main provisions, and again, I know everybody's getting a little bit of Paycheck Protection Program fatigue, but bear with us. We've only got about another May 31st and June 30th to actually apply for the loans. But here's a couple of the changes that the Act made. First, it added another $7.25 billion to the funding, which, I mean, $1 billion is a lot of money. But when you take a look at the funding that was actually available through the CAA, the Appropriations Act, I think they increased that another $284 billion. So you figure you got roughly 290 out there now. And I think the last that I looked, they put a report out, and they do it every couple of weeks, about the amount of funding that was used. And I believe it was around 223 or 230 billion at that point in time. I've been hearing various, things back and forth about whether they think they're going to run out of money or not going to run out of money. But I just have this feeling that, Congress is not going to let this thing run out of money, especially when they extended it to May 31st. So, but keep an eye on that if you happen to be holding off, or as we'll talk about here in a little bit, if you are uncertain about whether the new rules actually make you eligible or not, because there's a couple things here that are probably really questionable as to what the definition is going to be, and we have absolutely no guidance from SBA or Treasury yet on what those provisions are. So what did it do? It expanded eligibility. The first item there, the digital media companies. Somebody's got a really good lobby to get that narrow of a type of company eligible for the PPP loan. Anytime they narrow it down to one, Naxos code, it's a really narrow exception. So what they're really saying is that you got to have a Naxos code of 519130 in order to qualify under this provision. So again, when I see something like that, that just tells me somebody probably had a pretty good lobby back there and got that provision into the act. The second one, this is a big one. It's a big one, but it also led to some really big questions. It said all 501c3 organizations, are eligible, and there's a 500 employee limit, but it's per physical location. That's the rub here, okay, is that we really don't know what a physical location is. I know that people are kind of making their own definitions, and honestly, until we get some kind of guidance, that's really what you have to do. Now you have to be reasonable, I think, with it. But I mean, here's a good example. If I've got let's say I've got a hospital, and across the parking lot, they have a surgery center, and both of them have less than 500 employees. Is that two different locations, or is it a campus? Separate street address? What is it? I mean, I had somebody go so far as to say, well, we're a private university, we're 100% online, so all of our faculty are doing this out of their houses, so we think each house is a separate physical location. I think that's probably bordering a bit on extreme, that particular case. But, again, as I've said throughout this thing, is that we have some subjectivity here, and sometimes, opportunity lies in subjectivity. So just as long as you're reasonable, you document why you think that you would qualify. Look, at some point in time, they're going to come out with this definition. The problem is, if you're kind of fighting through that right now, is that you've got a May 31st deadline. And if they don't get you some information by May 31st, I mean, you could be out of luck and you may just have to apply for the loan. If they come back later on and says, this is a definition of a physical location and you don't match it, you may just have to give the money back. But at some point you got to make the call that, look, we have to apply. For those people or those organizations, I would really strongly suggest that you keep an eye on the funds available. Okay, because if it starts to run out of money, you may want to get that application in, using reasonable assumptions, and if it gets you to qualify, then go ahead and get the application in, but know very, full well that at some point they may come out with definitions here that you don't fit, and you may have to give that funding back. But the key is to get it. So other organizations that qualified, basically almost all 501c, if you're exempt under 501c, 3 we dealt with, 4, 6, and 19 have been dealt with on one-off type things. But any other 501c organization is going to be eligible as long as you have less than 300 employees per physical location. I'm going to put another little asterisk by that as well, because under the SBA rules, they have, it's actually the Small Business Act, they have a list of trades or businesses or types of organizations that by definition are not eligible. Let me give you an example. A lot of people, saw this provision and said, well, country clubs are going to be eligible because, they're exempt, I believe, under, Jesse, correct me, C7, if I'm right?
Yeah, I think C7.
Okay. But the SBA, the Small Business Act, also had a provision that said, look, no organization can receive a loan under this section, if their membership is on something other than capacity. So if you're, whatever the rules are regarding membership of a country club, it does not qualify under that provision. So you have to be a little careful that just because you're a C, exempt under 501c, that you are automatically eligible. Just check those provisions in the Small Business Act, and you'll be able to see whether you are or you aren't. C6 organizations and destination marketing, the only reason I put that on there, they became eligible under the Appropriations Act that passed in December. But what expanded here is that now it's the 300 employees per location. Okay, and again, can be a big issue for people to get to qualify when you have a per location versus a total organization type concept here. So, greatly expanded here. Going to be a benefit for a lot of people, but there is a bit of a mad rush here, to get the applications in. Can we flip to the next one? Okay, just touch briefly. I think you're all aware of the second draw PPP loans. Again, that was, from the Appropriations Act in December that passed. And all what happened with the current provisions is that it expanded the ability to get a second draw loan to the newly eligible people that we just went over on the previous page. Maybe somewhat of a moot point, because in order to get the second draw loan, you have to have, in essence, used or will use all of the first draw loan. And I just don't think that there's going to be enough time there to actually get both of them spent. But in any event, they would be eligible for the second draw loan. Okay, next slide. Actually, I did want to touch on one more thing. You don't have to go back to the slide, but don't forget, a lot of people were kind of taken, at least I was surprised by one of the provisions back in the Appropriations Act in December, that if you had previously gotten a PPP-1 loan back, when the world was crashing down around our heads and everything in April and May of a year ago, if you had gotten one, but then you subsequently said, look, they're putting this, need certification on us. I don't know if I can meet it. I don't want to go to jail. They're threatening me with, all sorts of, sanctions if I didn't really need the money. And so you gave it back, or you gave a portion of it back. Remember that the Appropriations Act in December now allows you to go back and to get that money back and reborrow that money that you may have paid back previously. So don't forget that benefit is out there. So you don't necessarily have to apply for a PPP-2 loan. You can actually go back and get the PPP-1 that you had previously repaid. So just, I think it was fairly surprising when I read through that, and I'm not sure what the genesis of that provision was, but it was a benefit. And I've had a couple of people that have actually gone back and do that. I would tell you this, that, it's kind of the exception, and when you deal with the program and the SBA, exceptions are not very very smooth if you're trying to get that loan under those provisions. It's been, a bit of a battle with the lenders, trying to get those things through, because it's kind of a square peg in the round hole type thing for them. Okay, loan forgiveness. This is kind of I'm going to just touch briefly, just an expanded item that you can use your PPP funds on, is for COBRA continuation coverage. Remember, that's kind of, there's a credit out there for this as well. So just be aware that if you're struggling to come up with enough payroll cost, that if you do have some COBRA stuff out there that you're being forced into, that this may be a way for you to use some more of those PPP funds for payroll. Next one, please. Okay, this was significant, that came through. If you remember, we all of a sudden, all these people were made eligible, but they only had like a month, to apply for the PPP loan, because it initially extended in March, on March 30th of the current year. Now we kind of have a dual deadline out there. You have to have your application for the loan in. Now remember, this is either a PPP2 loan, or if you have never applied for a PPP loan, it'd be your PPP1 loan. So you have to have applied for that loan by May 31st of the current year, and that will give the lender and the SBA, time to process those loans, by the end of June, which is in theory going to be the ending due date. Now I'll tell you that they will probably, say, look, we aren't going to cut this off at June 30th. So my guess is that if you get your application in by May 31st, you're probably going to at least get it, looked at. They may turn it down for some other reason, but I think you'll at least get it looked at. I mean, what we found in, so far is that deadlines don't apply to the SBA. They're kind of a one-way street. Any of you out there right now who have loan forgiveness applications in that are over $2 million, that's the case. They're supposed to have what, 90 days, to get their decision down to you. I've got some that have been in there for 6 months. Okay. And again, there's no ramifications, there's no teeth in the rule that they have to have it back by that time. In fact, we had a webinar last week, Jesse and I did, with, and we had an SBA representative on there, and, we wanted to have a discussion on that. And his response is basically, look, just be patient. We have a lot of stuff to work with and work through. So like I said, they kind of hold the cards, in that respect. And so you just are probably just going to have to be patient, although I know how frustrating it gets, to not hear anything back. And then I guess I would say kind of the other extreme, not extreme, but for loans under 2 million, we're seeing those moving through really fairly quickly. But what I am seeing, and it's a little troubling, I had a discussion with a lender yesterday who said they are getting a lot of questions back from the SBA on smaller loans, wanting more documentation, wanting to know what the bank did as far as, certain due diligence procedures that they're required to do, which is very surprising because these are relatively small loans. So he was kind of under the view that, maybe they're just trying to get the word out that, hey, look, they are looking at some of these smaller loans. So, don't, just try to mail it in and make up some information. So, but I was a little surprised by that, especially when they, don't have the other larger ones moving through at the pace they were supposed to. So anyway, a little bit of extra time, to get your applications in. Thanks. Run to the next one. I think we're talking about a favorite subject, a newly favorite subject, to a lot of employers. And again, I wish I could get a show of hands out here about how many that are on the webinar today have taken advantage of the retention credits. I mean, prior to December, the Appropriations Act, most people haven't even heard of this, okay, because we weren't eligible. Anybody who had a PPP loan, they were not eligible for the retention credit. It was one or the other. But with the passage of the Appropriations Act, they did allow you to do both. Now you can't double count on the wages. Again, it's another one of those, you can't double dip things. But these retention credits are a big deal. When you actually sit down and put a pencil, if you qualify, and I don't want to go into all the qualifications for it. If you had some questions about whether you do or don't qualify, reach out to Angie or Jesse or myself, and we can certainly sit down and walk through that with you. But if you do qualify, these credits are big. It's up to, if you qualify in 21, it's up to 70% of the first $10,000 of compensation per employee per quarter. So $7,000 credit per employee per quarter if you qualify. And I mean, you do the math in your head and that number adds up really, really quickly. Well, you may say, well, look, I don't have enough tax, to offset it, that do me any good. That's where it gets, even better, that this is a refundable credit, which means you don't have to have the tax, in order to get the credit. If your credit's more than the tax you owe, then they will send you a check. And to clarify, this is a credit against payroll taxes. It's not a credit against income taxes. Everything is done on your 941 forms. Or if you want to get an advance, there's a form 7200, that you could do as well. So, so again, this is pretty lucrative. Now, the one thing I would throw out there, and I don't have on the slides because it's more of a timing issue, is that most of you are getting ready to file, or most of your payroll processors are getting ready to file your 941s for the first quarter. Those are due April 30th, but if you use some of the big processors, they start filing them in the first week of April, okay? And if you're still evaluating whether you do or you don't qualify for the retention credits for the first quarter, you might reach out to your processor and say, hey, look, don't file my 941 yet, okay? I'm still evaluating this. Because, if they file the 941, it just, increases the administrative burden that you have to claim the credits. Now you got to file an amended 941 for the first quarter. You're going to wait much longer for the actual refund. So if you're evaluating it, or if you have already determined that you're eligible, okay, but you have not passed it on to your payroll provider yet, because they need that information. We're seeing about a 50-50 mix about whether the employer calculates a credit or the payroll processor calculates a credit. So just be careful, of who's doing it, because if you calculate it, you file the 7200s. Okay, that's the form to get the advance on the credits. Your payroll processor has to know that, to file the 941s correctly. So you've got to have some communication with them right now. And if you got a direct line to a rep or somebody like that, look, you're not going to be the first one to call them and ask them about this, but I would strongly suggest that you get on their radar right now. We've had a bunch that, got filed already, so we're going to have to do 941Xs, but I would rather not, because the refund will just get there, much, much quicker. So I would ask this, if somebody, has had some experience filing the form 7200, which is the advance, if you might type in the Q&A box if you've gotten the refund yet and how long it actually took. I'm trying to get a bit of a read on what kind of a time period. I've had some that it's been 2 to 3 weeks, and some, they're still waiting. So it's a bit across the board. But if somebody does have some experience, they want to type that in the Q&A box. We appreciate it. Okay, so what did it do? Well, we now are extended to December 31st of 2021. It was scheduled to expire, in the at the end of the second quarter, but now we're all the way to the fourth quarter. Each quarter, you kind of have to evaluate on its own about whether you're going to meet the qualification. But the fact that you've got 2 more quarters out there is a significant deal, to a lot of employers. Now, remember, one of the qualifications is you have to have a revenue reduction of, in this year, 20%, as compared to the similar quarter back in 2019. There are some real complicated rules they had out there, prior to the bill being passed, about if you were not in operation in the comparable quarter of 2019. They really simplified that, with what they did under the act. So basically gave you in essence, a very objective fixed formula to do. So if you weren't in operation during all of 2019 and you're trying to evaluate, a 20% reduction, take a look at the rules that are in here, because it's much simpler. Okay, the election to use a previous quarter, this actually got somewhat outdated after the IRS issued a new revenue notice last week, I believe. It was Revenue Notice 2021-23, which gave a little bit more guidance to the credits for the first 2 quarters of 2021. But we were concerned that, remember, one of the provisions to determine whether you have a reduction of 20% or more, you can look at the prior quarter. And they said in the rules, in the FAQs, that there is an election. You have to elect to use the prior quarter. And anytime we see that language, it always gets us a little nervous, because, what form is the election? Some elections are just passive. You do it and you made the election. Some of them you actually make a formal election and file it somewhere. So we get a little nervous when we don't have a lot of guidance. Well, they kind of clarified it for us in the notice that came out, and there is no written election that needs to be made. It virtually is a passive election. You basically do it, and you deem to have made the election. So that's a benefit for us. And I think Jesse has actually updated the slide here to reflect that. So kind of a big benefit, because that always does get us nervous. We go flip to the next one. Okay, they came up in the Recovery Act. They came up with two new types of businesses that could be eligible for the credit, regardless of other factors or other qualifications. The first one is this thing called a recovery startup business, and what it really amounts to is, look, if you started a trade or business after February 15th of 2020, first, God bless you for taking that risk on. They're going to allow a special credit for you, retention credit of up to $50,000 a quarter, so long as you make certain gross receipts requirements. So gross receipts requirements, and you're actually in business in the quarter in which you're trying to get the credit. So again, same type of calculation, 70% of the first 10,000 of a comp, capped at 50,000 per quarter per employer. Now, the thing to recognize here, and it's kind of lost in some of the detail, is that these provisions that we're talking about right now were put into a separate code section. I believe it's code section 3134. Prior to this, it was strictly just in the CARES Act and the various acts, beyond that, and a bunch of FAQs. Now it's got a code section, but what happened at the last section of that code section, they have an effective date. And it basically says these provisions in this code section are applicable only for periods beginning after June 30th of 2021. So it basically means that this retention credit for the startup business is only applicable for the third and fourth quarter of this year. So that's a very, very important distinction, is that it's not retroactive to the first quarter of this year. It's not retroactive to 2020 like a bunch of the other retention credits are. So a little bit of a oh by the way type thing that does kind of maybe catch some people off guard, that they aren't really eligible for the retention credits in this quarter. We go to the next slide. This is an interesting one, and it makes sense. You remember that in order to qualify for the largest benefit of the retention credit, you have to meet certain employee thresholds, okay? And for 2020, that's 100 full-time employees, and for 2021, it's 500 full-time employees. So if you're under those thresholds, the credit is 70% or 50% in 2020 of the total amount that you pay to your employees, up capped at the 10,000. But what happened here is that there were so many businesses out there that were just devastated, that we're not qualifying it because, during the measurement time period, which is 2019, when you measure the number of full-time employees, they had a lot of employees, and so therefore they got thrown out, but they just got absolutely decimated, on their revenue. So they came up with this concept of a financially distressed employer. And so what that really means is that if you have a 90% reduction, okay, in your revenues as compared to the same quarter in 2019, they said, look, you can qualify for the full amount of the credits regardless of the number of full-time employees that you had in 2019. So a really big benefit to those that are hit. Now the question becomes is, how big of a deal is it? Because it's based upon your current payroll. And if you're down 90%, you may not have that many people back on the payroll, but the ones you do, you will be eligible for the credit on. So just another one to kind of keep in mind. Again, effective for third and fourth quarter of this year. Next slide. Again, just more of a reminder, you can't double dip on these things, so just be careful of that. And then there is some provisions, and it's actually in an FAQ or a revenue notice that Jesse's going to go over shortly, about if you had filed for forgiveness on your PPP loan and you maybe use more wages than you needed to, or let's say you got declined on your PPP loan, can you go back and use those wages? So most of it is really employer friendly when you look at it, but Jesse will touch on a couple of those here in a minute. And I think, this one, this is kind of important. We thought this might be coming, is that remember, these are employment tax credits for employment taxes that are claimed on your 941s. What they came up with in the ARPA was, look, we're going to have, if you claim the credits, we're going to extend the statute of limitations for us to look at that and make an assessment from 3 years to 5 years. Probably not a big deal. And again, remember, this is where maybe the effective date will help us, but this probably is only going to be effective, for third and fourth quarter payroll filings. And Jesse, I think that's kind of where we landed on this thing, that it was going to be just for those 2 quarters.
Yeah.
Good. So again, probably not a lot of exposure, but look, if you're taking the credits, you've done the calculations, you qualify for it. So it really probably isn't all that big of a deal. Put it this way, I have not had anybody tell me that they're going to be scared off of claiming the credits because they have to extend the statute by a couple of years. So, okay, quick run through on that. I think Jesse is going to go over the revenue notice here next, and then probably leave a little time for questions.
Right. Well, thanks, Tad. A lot to cover there. But one thing I do want to just reemphasize, as Tad talked about, this is a payroll tax credit. And, particularly if you're attending today or not for profit, a lot of times not for profits maybe look at some of these credits and think, well, it doesn't apply to me. I'm a not for profit. I don't pay income tax typically. And just want to make sure that to reiterate that, this is available for both for-profit entities as well as not-for-profits. Now, there are some limitations as far as government employers, and we'll talk about some of the carve-outs there here in a second. But again, it is, as Tad talked about, can be a very sizable credit based on the calculations, and if you meet one of the tests, either the receipt reduction test or the governmental order test, which that's probably been one that's been very subjective in terms of whether or not I qualify, because under the ERC rules, if you were had a full or partial suspension of your business as a result of a governmental order, then you could potentially qualify during that period of time that you were suspended or under that government order. Now, part of this guidance talked about, it has to be more than a nominal effect on your business in terms of that order, the governmental, local, state governmental orders impact on your business. And there's a lot of uncertainty as far as what do we mean by nominal. How much is nominal, how much activity or how much suspension has to occur before I kind of exceed that nominal type hurdle. And the FAQs, frequently asked questions, the IRS posted on the ERC has some examples. Really, the one example was a grocery store with a salad bar that customers can make their own salads. Prior to the government order that restricted their business, after that order came out, they had to serve or prepackage the salads, and at least in that example, that was deemed to be nominal, so they would not qualify. Well, that's one very narrow example, and doesn't provide a lot of objectivity for other businesses. So under this IRS guidance notice 2021-20, it did provide some objective factors as it relates to the nominal test. And essentially it's a 10% test. So if more than 10% of your receipts relate to that portion of the business that was impacted, either fully or partially suspended, then that's deemed to be one of the nominal. Or if the hours of service performed by the employees in that portion of the business are not less than 10% of total hours of all employees, then again, it would deem to be it would be more than a nominal portion. So you would not fall under that exclusion. Next slide. The notice also provided various factors for employers to consider when determining if they can continue comparable operations. Because one of the keys is even if you were ordered to shut down, but your employees were still able to work remotely, and really, there wasn't really a more than nominal impact on your trade or business, then it's not considered to be a full or partial suspension. But again, a lot of subjectivity there as far as how comparable is my operations remotely versus before the pandemic, before the governmental orders. And so some of the factors they listed out to consider and do this evaluation is things like telework capabilities. How portable is the employee's work? Do they have to actually be in the employer's workspace to do that job, or can they just as easily do that job in a remote location? Also, in terms of the delays, did it take an employer, in the example in the notice, is more than 2 weeks to move their operations to a remote environment? Then that is deemed, if it took longer than that, then there's a stronger factor that you were not able to continue comparable operations. Okay, next slide. Also provided a little bit of guidance as far as how you actually claim it. Nothing too earth-shattering here, but essentially for those, as Tad mentioned, particularly PPP borrowers who maybe didn't claim the ERC on their originally filed 941s in 2020 for the second, third, and fourth quarter if they qualified. It did provide guidance to say, okay, if you didn't, then you need to file an amended payroll return or Form 941X to go back and claim that refund. And then also provided some various substantiation requirements as far as what an employer should retain within their records if the IRS were to examine that ERC claim. Okay, next slide. It also, and this is obviously one of the big issues as it relates to kind of the no double dipping rule, but it did provide some guidance as far as how the ERC interacts with PPP, because as Tad mentioned, with the Consolidated Appropriations Act passed in late December, PPP loan recipients are now eligible for both PPP and ERC, but you can't use those same wages to receive forgiveness as well as use those wages to receive an employee retention credit. So lots of questions that came out, from borrowers in terms of what if I already submitted my forgiveness application, or what if I didn't put all my eligible costs on my forgiveness application, and so forth. So the IRS did provide various examples in this notice. So if we go to the next slide, one example that was provided is a situation where a borrower maybe entered more wages on their forgiveness application than what was really needed to achieve 100% forgiveness. So in that situation, the IRS says, okay, if you only needed $200,000 of wages to receive full loan forgiveness, but you, simplicity, just reported the whole $250,000 that you incurred during your cover period on the form, then you are still able to apply the ERC against that excess $50,000, again, to the extent they are otherwise qualified wages. So very favorable result there in example one. Now, if we go to example two, excuse me, in this situation, we have an employer that reported both payroll costs as well as non-payroll costs. As if you recall, for PPP forgiveness, you can use up to 40% of eligible non-payroll cost on your forgiveness application. So in this situation, say you put 200,000 of wages, but you also put on your forgiveness application 70,000 of eligible non-payroll costs. So you had again more cost reported than what your full loan forgiveness amount was. So in this situation, again, I think it was a very favorable result for taxpayers. Is okay, we're going to treat the payroll cost and the non-payroll costs as applying first. So in this example, they would apply the 70,000 against your loan forgiveness first, leaving 130,000 of loan remaining, and that would then be filled up with 130,000 of the payroll, leaving 70,000 of wages eligible for the ERC. Now, in the last example here, this one is not so favorable, and probably a very common one, and hopefully maybe we can get some more guidance from the SBA or some other solutions, but it's really a unfortunate answer, because in this situation, a lot of times with the 24-week covered period, you're most likely going to have more than enough payroll or non-payroll costs, or enough payroll costs to achieve 100% forgiveness. And as a matter of simplicity, a lot of times borrowers may just put only payroll on there, even though they could have used up to 40% with eligible non-payroll costs. But again, you have to provide all the other different documentation. If you do that, it's just a lot easier just using your payroll, because it didn't matter at the time if you applied for forgiveness prior to the December passage of the Consolidated Appropriations Act. But now that PPPRs can qualify, they're kind of put in a bad position here if they already applied for forgiveness and had those eligible non-payroll costs but didn't include them. But at least as of right now, IRS is saying, well, sorry, if you didn't put them on the forgiveness form, then we're still going to treat the payroll cost that was used on the form for forgiveness. So unfortunately, that's not a good answer for those that have already applied for forgiveness. But I think it also raises a good planning idea for those who haven't applied yet for their forgiveness, in terms of maybe going back and making sure they've found enough non-payroll costs that are eligible to fill up that 40% bucket to leave more of their wages eligible for the employee retention credit. Okay, next slide. Then the IRS just recently issued another notice, 2021-23, and this applies to the first 2 quarters of 2021. They'll be issuing another set of guidance here sometime to apply to the 3rd and 4th quarter of 21, but not a lot of new things in here in terms of things we didn't already know, but it did provide some more definition around those eligible governmental employers, because under the Consolidated Appropriations Act, it did expand the eligibility to colleges and universities, as well as government entities that provide medical or hospital care. So it did provide a little bit of definition around what those terms mean. As Tad mentioned, it also did confirm that the immediately preceding calendar quarter election for purposes of your gross receipts test is actually a quarter by quarter election. It's not binding. If you make it once, you're not bound to make that election again the next quarter. And you make the election just by using the prior quarter receipts. So there's no affirmative election statement. And also just some guidance as far as that 70% limitation for those that are able to receive an advance payment of the credit if you're a small eligible employer, i.e. you're under 500 or more or less full-time employees. Okay, next slide. I want to just real quickly, and again, I think these slides can be available if you request them after the webinar, but we do have a couple of flow charts here just to kind of walk through the various kind of decision points and eligibility requirements for both the 2020. And the next slide we have here is the 2021 flow chart. So again, just a lot of complexity and different factors you got to think about. So that hopefully this flow chart kind of helps you walk you through as far as whether or not you're eligible. Okay, so moving on now to another provision that was in the ARPA, and that relates to restaurants. So this is another grant program. Yeah, the SBA is going to be administering. It's about 28.6 billion of funds appropriated to it, but it's going to be specifically for the restaurant industry. And that also includes things like food trucks, as well as bars, tap rooms, taverns, and so forth. So essentially any place where the public goes to assemble, and the primary purpose being, to either eat or drink, then they could potentially qualify for this grant. And now there are some exclusions for publicly traded, or if you have more than 20 locations. But as far as how much this grant could be, if you go to the next slide, it's based on your pandemic-related revenue loss. However, there's no requirement that you have to prove that your revenue loss was related to the pandemic. Basically, you just look at what's the difference in my gross receipts in 2020 compared to my 2019, and whatever that difference is, assuming it's less in 20 than 19, then that's my potential eligible grant amount, and it's up to $10 million is the max, or $5 million per physical location. Now, if you apply for the grant and receive more than maybe what you actually should have, or you didn't have enough expenditures to use the grant money on, then there is a requirement to return that extra money to the Treasury. And as far as what expenses qualify, it's pretty much everything that you would think a restaurant would have. So I don't think if you're in operations, it's going to be a very challenging to find enough expenditures that qualify to use the grant money on. So again, this is not open yet. I think the SBA is planning to open this up hopefully sometime this month, but just again, another program to be aware of, particularly if you're in that restaurant industry. Okay, next slide. Then also they are not treated as taxable income, similar to PPP. So You have tax-free income for the grant receipts, as well as you still get the deductions for the expenses paid with the grant funds. So again, very, very favorable. And then also, if you go to the next slide, has some additional EIDL funding. We'll just kind of walk quickly through this, and we're kind of short on time here, but did also provide some additional funding for the economic injury disaster loan advances. And next slide, there was some discussion around or some additional allocation of money to the SVOG, the Shutter Venue Program, 1.25 billion. Also importantly, it did remove the requirement that prohibit an entity from receiving both a PPP loan and the SVOG. But instead, if you received a PPP after December 27th, then essentially you have to reduce your Shutter Venue grant amount by that PPP loan. And as we talked about at the beginning of the presentation, tomorrow is the big day. So if you're one of those entities eligible, tomorrow is going to be a big opportunity. Probably a lot of people hitting that portal tomorrow. So just be prepared and get your application in as soon as possible. And then the next slide is just again a kind of a summary of all these different programs, and trying to kind of outline some of the basic eligibility requirements, how they interact with each other, because there are different limitations as far as if you're in one program, what you can use the money for, whether or not you can qualify for another program if you took a PPP or ERC. So this slide just kind of summarizes all those interactions, as well as the tax implications of the money received from those different programs. And then finally, I think this is the last slide here, just in terms of what's next, there is certainly more discussion going on in Congress in terms of another round of legislation. This one's probably more focused on infrastructure. Recently, the Biden administration released a plan about 2.3 billion or trillion, sorry, 2.3 trillion plan related to infrastructure, and this one does include various revenue raisers. So a lot of what was laid out related to corporations. So a lot of potential provisions that could impact if you're a C corporation in terms of potentially increasing the rate up from 21% to potentially 28%. Potentially some changes to the international tax rules, and probably importantly, particularly in Oklahoma with the oil and gas, some potential elimination of certain tax preferences for the fossil fuel industry are some of the different revenue raisers thrown out there in their proposals. So much more to come. Obviously, we'll keep a close eye on this to see where things go, but it is very much high on the agenda for the Biden administration and Congress to potentially get another piece of legislation pushed through as it relates to stimulus/infrastructure type funding. Okay, and then just real quickly, we do have a resource center on bkd.com there. If you want to go look at some of our thoughtware and webinars and other resources, we have the link there for you if you want to check out our resource center. Okay, I think we're just a couple minutes over here, but I don't know, Angie, if we have any questions we want to address.
So I know that I've had a lot of discussions, and I know that you have too, in related to the affiliation and aggregation of both PPP and ERC. Are the rules similar to determine who are affiliates in both programs?
No. To be kind of succinct, the PPP loan, remember the affiliation and the aggregation rules generally going to come back to get you in the number of employees that you have and any revenue reduction, because if you deem to have affiliates, you have to look at the entire affiliated group. So for purposes of PPP loan, SBA they actually have a pretty thick book about who is deemed to be affiliated, who you'd have to aggregate with. And theirs is a bit more subjective. They have some requirements that if there is a common control, that you are deemed to have affiliates, you would have to aggregate all those affiliated groups. Under the retention credit, these are strictly Treasury rules. And again, the programs are administered by two different people. ERC retention credits is by Treasury, and their rules are much more objective. They can still come back and get you, but you really do need, if you've got if you got related entities out there, you probably better, you know, get in touch with somebody who's familiar with those rules under the code and the reg. There, section 52 is where they reside, and some in 414, but they can be fairly intricate and complicated about whether you have to affiliate. And actually, you know, quite honestly, there are some situations where aggregation is a benefit, affiliation and aggregation, but just be aware that you can't just look at your own standalone employer if you have other entities out there.
Thank you, Tad. Megan, I think that's probably, we're at our time limit, so I will turn it back over to you.
Thank you, Angie. I'd like to thank Tad Goodenbour, Jesse Palmer, Angie Tai, and Jill Young for their time in sharing this timely and valuable information with us today. And we would like to thank all of you for joining us today's session. Please be sure to follow us on social media. If you have any questions from today's session, if you would like a copy of today's presentation, or if you would like to be connected to a resource from either Summit or BKD, please feel free to email us at marketing@yoursummit.com. But for now, thank you so much for joining us. Have a great rest of your day, and we'll see you next time.